This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Investment Perspectives. I'm Ed Brooke, and today we're going to discuss some of the broader topics impacting markets in 2025 and beyond. And it's an important time to do so, as September has typically been a tough month on markets, a time when investors reflect and then think about positioning as we head into the fourth quarter. So joining me as always to provide the insights is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
Tracey, we had a lovely client lunch in Newcastle this week, and one of the topics of conversation was, not surprisingly, AI. But the question was more around, is AI an era or a regime shift?
Yeah, it was a really good discussion and an interesting topic. I would argue that it is more than an era. If we think about it, we've had now quite a few eras when it comes to technology. We had the mainframe era in the 1970s. That was with the likes of IBM. We had the internet era in the late 1990s, of course, with Yahoo and Intel. And then the mobile era in the late 2000s with say, Apple. And now we have AI. But this, I would argue, is more than an era. It is more like a regime shift or even a revolution. AI is changing how we live, how we work, how we play. Previous eras, I think, were more situational, more narrowly focused. You know, the late 1990s internet boom was really concentrated in three sectors: technology, media, and telecommunications. It was known as the TMT boom. This AI era is significantly broader than that. New infrastructure is being built, whole industries are being disrupted, and national champions are being identified. As was the case in previous revolutions, the economy needs to be remade. Rules have to be rewritten. And certainly, I think part of the Australian government's productivity roundtable recently is in recognition of this. You know, with previous revolutions, the government needs to rethink how and who and indeed what it taxes. And so I think digital services taxes are being more widely discussed and will ultimately be implemented. And governments need to take an active role in all of this, including regulation, retraining of people, and redesigning the tax system. If then you look at the top 20 performing stocks year to date, Ed, not one is a Magnificent Seven stock. In fact, there's not even a Magnificent Seven stock in the top 50. You have to go all the way down to number 58, where Nvidia currently sits. The current list of top 20 stocks are broadly dispersed across 8 different sectors, including utilities, industrials, and materials. And so I would argue that AI is the all-in boom.
Tracey, political unrest seems to be on the rise at the moment. We're seeing protests in Sydney and Melbourne and other capital cities around the world, protesting immigration, among other things. Politics is always a difficult one to price. How do you and the team think about this growing unrest?
You're right. It is very hard to price, but it is not going away. Inequality, in our view, is flashing red. Wall Street asset values are running at 6 times Main Street GDP, just shy of the peak in 2021. Debt in the US has ballooned now at 37 trillion. That is eclipsing the combined economies of China, Japan, Germany, and India altogether. It's bigger than all of those. The Italians last ran a surplus in 1905. Probably some of us would not be too surprised by that. But the US hasn't seen a budget surplus since 2001. Our government situation is not as bad as that, but rising inequality is certainly very evident. Housing inequality is very clear. Mervac said this week that there will be a portion of the population that will be renting forever. That is bad for people, but it is also bad for the government. Academic research strongly supports the situation that a lack of home ownership is a key indicator of poverty risk in retirement. So these retirees will become then heavily reliant on the government for support. So this has led to the rise in populist politics. It's really been going on since the GFC, where political leaders are now starting to stress local first policies and national interest, often at the expense of long-term global solutions. In terms of the left-right political spectrum, parties have moved to the extremes. There's been a hollowing out of the centre. At the extremes, there is more that separates us than brings us together, and this creates instability. So this is why we are seeing more protests in the street, and it can become self-fulfilling because protests weaken government mandates. Social unrest depletes political capital, and this leads to difficulty forming government and, as well, getting anything in the way of serious reform done. I'd be very surprised, actually, if the Albanese government gets any serious reform done out of the productivity roundtable. There's been a marked rise in coalition and minority governments generally around the world at the expense of traditional majority governments. And that's been the case in Australia as well as in many advanced democracies.
And so, Tracey, what does this mean for investors?
Well, at a global level, reduced cooperation between countries risks slower economic growth. It increases cost, and so inflation ultimately, and diminished innovation. Wars and social unrest are expensive for governments. Spending on defence is rising, and populations used to the constant injection of support during COVID are punishing governments who attempt to withdraw that support. And so we saw the extraordinary number: over 80% of democracies that held elections last year saw their incumbent parties lose seats or vote share compared to previous elections. This wave marked one of the most expansive global anti-incumbency phenomena in recent history, and it's being driven by rising inequality, government dissatisfaction, and social anxiety. At the same time, though, bond markets are punishing governments who don't take a more modest approach to fiscal spending. And so we're seeing governments are really between a rock and a hard place here. We now have what they call the fiscally fraught four. Excessive government debt levels in the US, the UK, Japan, and France are in the target sites for the bond market. So governments have a choice. Do they appease their populations who vote and keep the fiscal tap open, or do they appease the bond market and start to wind back fiscal excesses, adopt a more sober fiscal position? Have a guess which one they're going for. It is, unfortunately, that just at a time when we need government the most to rebuild defence forces, to meet energy needs for the future and support ageing populations, that they are bloated with debt, and debt reduction plans are hard to achieve. And so I would say here, Ed, that big government is here to stay, and that ultimately will weigh on economic growth and productivity.
So, Tracey, one of the other points of discussion recently has been around how governments have become less global. What do you mean by that, and what are the implications for investors?
Yes, this is a topic of conversation that we've had a couple of times in various meetings. I think generally we are in a more introverted world today. Governments are restricting the flow of people and capital and trade across borders. Fences between traditional allies are rising. And a simple homegrown example of this is the fact that our own Prime Minister still hasn't met with the President of the United States yet. At nearly 8 months into his term, this is one of the longest delays in modern history for an Australian Prime Minister to meet a newly elected US President. As governments become less global, then markets also become less global. So higher tariffs, less cooperation, and reduced trade flow points to that. The notion that the market, the equity market, is not the economy only applies to those markets where domestic share is low, such as the UK, where just 28% of UK company revenues is earned domestically. 28%, and that's quite low. In the US, it's 61% of company revenue is earned domestically. That's higher than in Australia at 55%. In this world, domestic forces play a greater role. And so the maxim, politics don't drive markets, markets drive markets, is no longer true. Politics is impacting company fundamentals more today. Trump wanting to take a stake in Intel or taking a commission on chip sales to China from Nvidia and AMD are examples. Trump wanting to interfere in the independence of the US central bank is another example. We're no longer in a world where a rising tide lifts all boats. I think we now need to think of it more like a series of locks that rise and fall at different times. And for us, actually, it's not a bad thing because as investors, that means more choice. We have the ability now to spread our risk capital further and in more diverse parts of the world. And so that ultimately reduces the risk in the portfolio.
Tracey, looking at earnings now, and Nvidia's earnings result last week was overshadowed a little by China's latest developments in AI. What can you tell us there?
Well, yes, Nvidia's China story has become increasingly complex amid mounting pressure, both from the US restrictions being imposed, slowing demand, and also rising competition from China. And so the latest news is all about how Chinese companies are racing to fill the gap in chip demand left by Nvidia because of the restrictions. Alibaba unveiled a new AI chip, and that has certainly prompted optimism about China's AI ambitions. Cambricon, a Chinese AI chip maker that we're probably going to be hearing more about, reported a record profit and an astonishing 4,000% rise in its quarterly revenue amid surging demand for domestic AI chips. One thing that we were reminded of by one of our fund managers last month, never doubt China as a fast follower. China is determined to be self-sufficient and cut its AI industry's reliance on chips made by Nvidia. They are aiming to triple AI chip output by 2026, part of a broader strategy there to reduce reliance on foreign suppliers like Nvidia. Huawei is setting up new AI chip manufacturing capacity to lead the charge. So it's no surprise then that the US government is cracking down even more. It has now sent a notification to TSMC, which is the Taiwan-based chip maker, the biggest in the world. The US sent it a note to say that it needed to get permission from the US to sell or ship chip-making equipment and tools to its own facility in China. The funny thing with this is that despite all of these restrictions being imposed by the US, China is progressing quickly down the AI self-reliance path. First, it was the arrival of DeepSeek, China's answer to ChatGPT. That was earlier this year. And now it's Cambricon, China's answer to Nvidia. All this in an environment of chip restrictions by the US. So don't underestimate China's ability to be a fast follower.
And of course, Chinese equities are on a tear right now. They were one of the better performing markets in August. How much of this rise is based on the fundamentals around AI, and how much is based on the FOMO trade, the fear of missing out?
Well, it is hard to argue against the rapid developments China is making in the AI space, but there is definitely an air of FOMO, the fear of missing out trade that you mentioned, circulating Chinese equities right now. Broadly speaking, the fundamentals haven't really changed for China. The property market is still fragile, demographics are still a headwind, and geopolitical tensions are still there. But what has changed is behavior. Retail investors have piled back in, and with it, dangerous levels of margin debt, which is now at a new record high in China. The rise in margin debt, so this is Chinese retail investors borrowing to buy stocks in the market, surpassed the last peak, which was back in 2015. Margin financing has spiked alongside the rally, and in China, retail investors dominate daily turnover. When they get excited, flows can overwhelm fundamentals very quickly. It's less about corporate earnings or reforms, and it's more about the herd, everyone jumping in because everyone else is jumping in. That tells you this rally isn't being driven by a sober reassessment of China's long-term growth story. It's being driven by a fear of missing out. We even have had the unusual situation where Cambricon, whose share price has increased by 100% in the past month. So it's just in the last month, up by 100%. The CEO of Cambricon is warning investors that its stock price may no longer reflect fundamentals.
And Tracey, I guess it's common, isn't it, for Chinese equities to experience sentiment-driven swings like this?
It is, because retail does dominate so much, and we've been here before with retail investors in China. They are notorious for trading on momentum and sentiment. The Chinese media are cautioning investors against speculation because it can be very damaging for the market. And this has reminded me, Ed, of something I experienced on a ride on the weekend. I found myself behind a fairly inexperienced motorcyclist. A good rider picks a line through a corner and holds it smoothly. But this rider didn't. He kept correcting mid-turn, veering across the road, and never really seemed to be in control. And what I noticed is that his erratic actions were starting to affect mine on my motorcycle. My decisions, my line, were being distorted just by following him. In the end, I had to overtake because otherwise his mistakes were about to become my mistakes. And so this is known as target fixation. It's not unusual to see 2 or 3 bikes crash in the same corner. The first rider gets it wrong, and the others behind, fixated on his movements, blindly follow him or her off the road. Fundamentals, the mechanics of riding, the training, the knowledge, all get overridden by the instinct to copy the rider in front. And that's exactly what we're seeing in Chinese equities. Fundamentals say caution, but the crowd says buy now or miss out. Retail investors are using leverage to chase the rally, and others are letting those moves dictate their own. I think the danger is obvious. If the first rider or the first wave of retail enthusiasm goes off the road, everyone else who followed ends up in the same ditch. So the lesson is simple here, Ed. Whether on the road or in markets, don't let someone else's mistakes become yours. Choose your own line, stick to your fundamentals, because FOMO may feel exhilarating in the moment, but it is a dangerous way to ride.
Thanks, Tracey. That's great advice. That's all we have time for today. I hope everyone enjoyed the update, and we look forward to you joining us for our next recording. Until then, please take care and stay safe. Thank you.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.